Let's face it, the market's been looking like that fourth cup of coffee you had, jittery and unpredictable. We've seen a pretty intense sell-off recently, and while some folks are hitting the panic button, I see opportunity. It's almost comical, right? Billionaires are out there talking about a detox period for the economy. You know, the same billionaires who made a killing during the last downturn. But hey, that's just how the cookie crumbles on Wall Street. The S&P 500 and the Nasdaq are both down and everyone's wondering what to do. Well, instead of freaking out, let's talk strategy. Let's talk about how to fortify your portfolio and even come out ahead when March 2025 rolls around. In this video, we're diving deep into 5 stocks that I believe are poised to not just weather the storm, but actually thrive in the years to come. We're talking healthcare, real estate, tech, international markets, and even a little something to hedge against inflation. Oh, and stick around because later this month I'll be dropping some updates on SoFi Technologies and some promising cybersecurity stocks. You won't want to miss it. Let's kick things off with healthcare, a sector that tends to hold its own even when the economy throws a curveball. I mean, think about it. People still need their medications and medical treatments regardless of what the stock market is doing. It's the epitome of essential. Now, one of my favorite ways to track the healthcare sector is through the Healthcare Select Sector SPDR ETF, ticker symbol XLV. This bad boy gives you exposure to some of the biggest players in the game. But if you're looking for individual stocks, I've got 3 words for you: Amgen, Eli Lilly, and HCA Healthcare. Amgen, trading under AMGN, is a biotech powerhouse with a long history of solid earnings and a juicy dividend. They're like the steady Eddie of the healthcare world. Then we've got Eli Lilly, ticker symbol LLY, another pharmaceutical giant that's been absolutely crushing it in the diabetes and oncology spaces. And let's not forget about HCA Healthcare, ticker symbol HCA, one of the largest hospital operators in the United States. They're benefiting from an aging population and the ever-increasing demand for healthcare services. Now I know what you're thinking, Graham, these are all well-established companies. Where's the growth? And you'd be right to ask that. But here's the thing. In uncertain times, sometimes it's better to have that stability and dependability, especially when these companies are still innovating and expanding. Think of it like this. You're building a house. You need a strong foundation before you can start adding those fancy upgrades. These healthcare giants are your foundation. They provide stability and resilience to your portfolio, allowing you to take calculated risks in other areas. But remember, this isn't about throwing all your eggs in one basket. Diversification is key, and that's why we're moving on to our next sector, real estate. They say you can't go wrong with investing in land, and you know what? They're not wrong. Real estate has historically been a fantastic hedge against inflation and a reliable generator of passive income. And while the thought of being a landlord might make you want to run for the hills, trust me, there are easier ways to get in on the action. We're talking about REITs, baby, real estate investment trusts. These are companies that own, operate, or finance income-producing real estate. Think shopping malls, apartment buildings, office spaces, you name it. And the best part? They're legally required to distribute a significant portion of their profits back to shareholders in the form of dividends. Now I've got 3 REITs on my radar that I think are particularly well positioned for the years to come. First up, we've got Plymouth Industrial REIT, ticker symbol PLIM. These guys specialize in industrial properties, think warehouses and distribution centers, which are in high demand thanks to the continued growth of e-commerce. Next, we've got Medical Properties Trust, ticker symbol MPW. As the name suggests, they focus on healthcare real estate, primarily hospitals. Remember what we talked about earlier? Healthcare is a recession-resistant industry, and MPW provides a way to double down on that trend. And finally, we have Digital Realty Trust, ticker symbol DLR. These guys are all about data centers, the backbone of the internet. As our reliance on technology continues to grow, so too will the demand for data centers, making DLR a compelling long-term play. Now I know some of you might be thinking, Graham, real estate is expensive. How am I supposed to afford this? And you're right, real estate can be pricey, especially in certain markets, but that's the beauty of REITs. They allow you to invest in a diversified portfolio of real estate assets without having to shell out millions of dollars for a down payment. Plus, with REITs, you get professional management, liquidity, and those sweet, sweet dividends. It's a win-win situation. Now let's talk tech. I know, tech has taken a beating lately. But remember what they say, buy when there's blood in the streets, even if it's your own. Okay, maybe not the best analogy, but you get the point. When others are fearful, That's often the best time to be greedy, especially in a sector as innovative and transformative as tech. Now, I'm not talking about chasing after the latest meme stock or putting all your money into some unproven startup. We're talking about established companies with solid fundamentals that are trading at a discount due to the overall market sentiment. And for me, two companies stand out: AMD and Supermicro Computer. AMD, ticker symbol AMD, has been absolutely killing it in the CPU and GPU market, going head-to-head with Intel and Nvidia. They've got a strong product lineup, a growing market share, and a management team that's laser-focused on innovation. Then we have Supermicro Computer, ticker symbol SMCI, a leader in enterprise computing, storage, and networking solutions. They're benefiting from the rise of cloud computing, big data, and artificial intelligence. And with a forward PE ratio that's significantly lower than the industry average, SMCI is looking like a steal right now. Now, I know some of you might be hesitant to invest in tech after the recent downturn, but remember, this is a long-term game. The tech sector is here to stay, and these dips in the market are just buying opportunities in disguise. Think about it this way: would you rather buy a house when prices are sky high or when they've come down a bit? The same logic applies to the stock market. Don't be afraid to buy when others are selling, especially when you're investing in companies with solid fundamentals and a bright future. Alright, let's shift gears and talk about international stocks. Now, I know it's easy to get caught up in the excitement of the US market, but trust me, there's a whole world of opportunities out there. Investing internationally allows you to diversify your portfolio geographically, reducing your exposure to any one country's economic or political risks. And one of the easiest and most cost-effective ways to invest internationally is through ETFs, specifically the Vanguard Developed Markets ETF, ticker symbol VEA. This bad boy tracks a broad basket of stocks from developed markets around the world, including countries like Japan, Canada, the United Kingdom, and more. Now, you might be thinking, Graham, why developed markets? Shouldn't I be investing in emerging markets for higher growth? And while it's true that emerging markets have the potential for higher returns, they also come with higher risks. Developed markets, on the other hand, offer a bit more stability and predictability, which is what we're looking for in these uncertain times. Plus, many developed markets are home to some of the most innovative and well-established companies in the world, companies that are leaders in their respective industries. Investing internationally is like adding another layer of protection to your portfolio. It's about not putting all your eggs in one basket and taking advantage of the growth opportunities that exist beyond our borders. Remember, diversification is key, and that includes diversifying geographically. Alright, let's talk about inflation. It's the silent killer of wealth, slowly but surely eroding the purchasing power of your hard-earned money. And with inflation still running hotter than a jalapeno, it's more important than ever to have a plan to protect yourself. Now, I'm not talking about stuffing your mattress with cash. We're talking about I-bonds, baby. Series Y savings bonds. These are government-issued bonds that offer a combined rate of return that includes a fixed rate and an inflation-adjusted rate. The fixed rate stays the same for the life of the bond, while the inflation-adjusted rate is adjusted every 6 months based on the current inflation rate. This means that as inflation goes up, so too does the return on your I-bonds, helping you to maintain your purchasing power. Now I know what you're thinking. Graham, bonds are boring. Where's the excitement? Where's the potential for 10 times returns? And you're right, bonds aren't going to make you rich overnight, but that's not the point. I-bonds are about preservation of capital, about protecting your money from the erosive effects of inflation. They're like the insurance policy for your portfolio, providing a safety net in case things go south. Plus, with I-bonds, you get the added benefit of tax advantages. The interest earned on I-bonds is exempt from state and local taxes, and you don't have to pay federal income tax on the interest until you redeem the bond. So if you're looking for a safe and reliable way to hedge against inflation, I-bonds are definitely worth considering. They're not the sexiest investment out there, but they can provide some much-needed peace of mind in these uncertain times. There you have it, folks. 5 must-buy stocks, or rather asset classes, that can help you navigate the choppy waters of the market and come out ahead in March 2025. Remember, it's all about finding the right balance between growth and safety. You want to participate in the upside potential of the market while also protecting yourself from the downside risks. And speaking of generating passive income, if you haven't already, be sure to check out my video on how to create a steady stream of cash flow from your investments. It's all about putting your money to work for you so you can achieve financial freedom faster. As always, thanks for tuning into the Piggy Bank Chronicles, your go-to source for all things personal finance. Be sure to hit that subscribe button and ring the notification bell so you don't miss out on any of my weekly insights. And until next time, stay caffeinated, stay invested, and keep building that wealth.